In this video, we're going to talk about candlestick patterns and price action trading. Now, before we get into the meat of the video, I just want to make it clear that this is not a replacement for studying Steve Nissen's candlestick patterns and any of his books that he's got out or his video courses. All we're going to show you in this video is how we go about using candlestick formation patterns to make our trading decisions, okay? So it's in no way an encyclopedia of candlestick patterns, it's just the ones that we use and how we use them and how we found them effective over the past few years. Okay, so candlestick patterns are based on an old Japanese charting technique, but they only really took off in the Western world in the last few decades thanks to a gentleman by the name of Steve Nissen. He's a guy in the US, a technical analyst in the US, and he's got many books out on the subject, and he's really kind of like the grandfather when it comes to this. But as I said to you just now, we're not looking to replace any of his teachings whatsoever. We're just looking to show you how we've used what he's shown us to make our decisions in the markets. Now, ultimately, the candlestick patterns help us to identify turning points in the markets because remember, we're swing traders. We're looking to take trades in the direction of the trend after a little bit of a pullback. So we're looking for anything that we can to give us an idea as to when that pullback has finished and when the dominant trend is about to take off again. But these must be traded in the right context to be effective. Now, what I mean by this is that I've seen it in forums before. Some of our members have sent us emails before about candlestick formation patterns that they've taken and they haven't worked out. Then you look at where they've taken them and it's kind of in the middle of nowhere. There's no other reason to be taking those particular reversal patterns. As we've said in the support and resistance lessons, the Fibonacci lessons, in a number of other videos, we're looking to trade in the direction of the trend in places where the rest of the markets are looking at. Okay, we're not looking to trade some sort of magic indicator or magic formula that nobody else can see. We want the big boys in our trades. We want the big boys buying into the trade the same point that we are so that it gives the trade legs to take us to our profit target. So for that reason, it must be traded in the correct context. Now, when I say the correct context, what I mean is it needs to be traded, first of all, you need to consider that we're looking to identify turning points in the markets. So it needs to be traded after a move, not after just like a consolidation period where the markets have gone sideways. That doesn't make any sense. We need to look for these reversal patterns after a move, after a bit of a pullback to a predefined level of support or resistance. And that is very important. So as I just said, it needs to be following a directional move to a key level of support and resistance. I really can't stress this enough. I know I've mentioned it a number of times already this video and over the course, but ultimately we're looking to take trades at predefined levels of support or resistance back into the direction of the predominant trend. Okay, so we're looking to take these candlestick reversal patterns after a directional move, but that directional move is not the trending move. The directional move that we're talking about is the pullback. So let's say, for example, we're in an uptrend. We're looking for a pullback down to a support or a resistance level where we're going to get a reversal pattern to show us, to give us an option to buy back the market. Does that make sense to you guys? When we trade these patterns, we don't just trade the pattern itself. What we look to do is we enter on the break of the price action candle. So you're going to see in a minute, we'll look at things like dojis and bullish engulfing patterns and things like that. But regardless of whatever they're called, what we're looking to do is we're looking to enter once price breaks that particular candle. It just gives us a little bit of additional confirmation. And then we place the stop the other side of the price action candle. Okay, but I'll show you exactly what I mean when we get to the charts and as we look over the next few slides in any case. So in front of you, let's first talk about the patterns that we're interested in. Now, as I said, this isn't an exhaustive list in any way whatsoever. This is just a list that we use, the sorts of patterns that we're comfortable taking. Now, if you're comfortable taking other patterns, that's not a problem. Please feel free to do that. But us personally, we're only comfortable taking the following 5 patterns that we're about to show you. The first of which is a shooting star. You want to see these at the top of an upwards move. Now, what's important here is to understand what the price is actually telling you. So beyond what it's actually called, beyond the fact that it's called a shooting star, what's the price telling you? Well, if you look at those candles, the price has started at the bottom of the candle, right? The price is pushed all the way to the top of the candle. And then at some point in time, the sellers have got involved and they've pushed it all the way back down again. So you see where the wicks are for that particular shooting star. At one point in time, those candles were very, very, very bullish, okay? At one point in time, they were basically green candles all the way to the top. But the markets have found it in them to say, you know what, we're not comfortable with the price being around here, so we want to sell it back down again. And that's how it ended up with a negative close. So the close is almost at around where it opened. So at one point in time, the candle was very bullish. It was all the way to the top of where the wicks are that you can see there. They were both green and they were fantastically bullish candles. However, by the time the candle closed, the sentiment had changed and you can see that the close was actually down towards the bottom. So that's our first clue that the price may be about to change. But remember, we only look to trade the price once it breaks the low of the candle. So once we see this candle close here like that, so let's take the shooting star for an example. Once you see it close like that, you're then waiting for the price to break below the low of the wick of those candles, and then you're looking to enter your trade. And you'd be placing your stop above the high of those candles there. The next candle that we're looking at is basically the opposite to the shooting star. We're looking for the hammer bottom. Now this is very similar to the shooting star, but we actually want to see it at the bottom of a downwards movement as opposed to the top of an upwards movement, which is what we wanted to see with the shooting star. The hammer bottom, the sentiment with the hammer bottom is that at one point in time, it was very, very negative. It was a very bearish candle. You can see that where those wicks are, ultimately you had, well, the whole candle was completely red. So the market was looking to sell, 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 sell. But by the end of the candle, the market had bought it back. And you can see there that actually by the end of the candle, the buyers were in control. The bulls were in control. Whereas in the middle of the candle at some point, the bears were in control. By the end of it, it was very much a buyer's market. And again, we would be looking to enter on the break of the high of that candle there, okay, to get into the trade in the direction of the stronger trend, which would have been the uptrend in the case of the hammer bottom. Because remember, we're looking for the hammer to occur at the bottom of a downwards move, and that downwards move that we're looking for is the profit taking from the strong upwards movement. But we'll show you more of that when we get into the charts in a moment. The other candlestick pattern that we like to see, although it's not as strong as the others, is the doji. Now what the doji actually shows us is indecision in the market. Now the thing with the doji is that it's not as strong as the others because you can't see clear sentiment here. The doji candles are very much kind of like, well, the markets don't really know what they're doing. But why do we look at it? Well, as I said to you before, we're looking for clues. We are detectives in the market and we're looking for clues. We're looking to build our case. Now, if we see the doji occur at the end of, let's say, a downwards move or an upwards move, or whichever way it is according to the trend that you're trading, if you see a doji, then what that's ultimately telling you is that the market isn't as positive or as negative as it just was. Okay, of course, we'd like to then see a shooting star or a hammer or a bullish engulfing pattern or a bearish engulfing pattern, as I'll just show you in a second. But the doji is kind of like the first clue. It's saying, look out, guys and girls, there could be a change on the horizon. Okay? So now for the bearish engulfing and the bullish engulfing. The bearish engulfing pattern we want to see at the top of an upwards movement. So we're imagining that we're in a massive downtrend and that upwards movement is a little bit of profit taking, so a little bit of buying in a very, very strong downtrend. If we see a bearish engulfing pattern at one of our support or resistance levels, which is where we want to see any of these candlestick reversal patterns, we would then say, well, actually, this is very, very negative. We want to be getting into the market here. Now remember, again, nothing is 100% in the FX markets. We can't say that anything's going to make you money 100% of the time. What we can do is we can look for patterns which are right, let's say more than 50% of the time or more than 60% of the time, and just trade them enough with enough of a risk reward to bring you out ahead of the game after the long haul, after a large enough sample size full of trades. So the bearish engulfing pattern ultimately is one candle, let's say a bullish candle or a bearish candle. Well, in actual fact, in the FX markets, it would have to be a bullish candle. The reason I say that is when you get the stock markets and stuff, you can kind of get gaps up and gaps down, but you don't really get gaps in the FX market. So after a move to the upside and you get a bullish candle, you then get a bearish candle where the body of that candle, the body of the bearish candle there, completely encapsulates the body of the bullish candle. Okay, so it starts towards the top of it and it completely engulfs it. It's much, much bigger than the bullish candle. Do you see what I mean? Can you see what's on your screen there? So the red candle for the bearish engulfing is much bigger and it completely encapsulates the body of the bullish candle. For a bullish engulfing pattern, it's pretty much the opposite. So you find it at the bottom of a downwards move, and what you want to see is that the bullish candle, so the green candle, completely encapsulate the previous bearish candle, the red candle there. And again, that gives you the opportunity, that gives you the signal to get into the trade in the direction of the dominant trend. Now, what we're looking to do here is we're looking to enter on the break of the high for the bullish engulfing candle or the break of the low for the bearish engulfing candle for our signal to enter. We would then be placing our stops above the high for the bearish engulfing or the low for the bullish engulfing candle. Okay? If you have any questions, of course, always feel free to post it below the video or send us an email or post it in the forum. But for the time being, I hope that's enough information to kind of get you started. And what we'll do now is we'll look at some charts on the slides and then we'll go and look at some live charts. So on this slide here, what we're looking to show you is the shooting star. Now remember, we have a few things going for this. First of all, we have this previous level of support, which could become resistance. We have that in our rearview mirror anyway. We're looking at this support level because we're looking at price to react to this level. We've got a downwards trend. Okay, so we're making lower lows and lower highs there. We've got a downwards trend. We've got a little bit of a pop-up, which was probably as a result of this support level over here. The pop-up is to this previous level of support, which could become resistance. You've got a few indecision candles there, but look at this. What is this right here? That is a shooting star that has got a massive wick on it. So at one point in the time, the price tried to get above this level, but it was quickly sold back down. As soon as it was sold back down, we would then look to enter. Once we get the close, we would look to enter on the low of that candle over there. So we'd be in on this candle here with our stop above the high. Now, as you can see, the sentiment is such that the markets then manage to hold below this previous level of support, which becomes resistance, and sell off all the way down here. Okay, and it really is as easy as that. Now, remember I said look at it and trade it in the right context. Well, look at these candles here. Yes, some of them worked out, but you can see that you do have dojis and shooting stars and hammers and everything else all over the chart. What's important is trading it in the right context. So what we're doing here is we see a downwards move, nice momentum, a nice pullback here to a previous level of support, to a predefined level. And that's where we take our entry. So that's one example of a shooting star for you. Here we have an example of a hammer bottom, and it's pretty much exactly the same as the shooting star. Remember, we're looking for harmonic price action. We're looking for a trend. We're looking for momentum. We're looking for previous levels of support and resistance, and we get all of that here. So we've got a previous level of resistance, which we would be looking to become support. Once the market breaks through there, we would definitely be looking for the market to pull back to that level. When it pulls back to that level, look at the candle there. We've got the hammer bottom there. At one point in time, that particular candle was very, 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 very negative. At one point in time, that candle was looking to break below this particular support level. So this previous level of resistance, which became support, that candle was very red. Well, it was a full-bodied red candle there, and it was looking to break below. By the time the candle closed, look, it closed up towards the highs. So we'd look to enter on the high of this candle here, on a break of the high with our stop below the low. And as you can see, once you've got the break above this, the markets pretty much just don't look back. And you can see that would have been a very, very nice profitable trade. But again, remember to look at it in context, in the correct context. You can see these sorts of candles all over the place. What's important is to trade them after the momentum move in the direction of the trend and then following the pullback. Okay, so this is profit taking here. After this profit taking, it comes to a predefined level of resistance, which becomes support. And at that point there, we look to get into this particular trade on the break of the high of this candle, stop below the low, and the market roars off into profit. And that's exactly what we like to see. Now let's take a look at the bearish engulfing pattern. Again, we're looking for the same things in the market. The only things that change is the candlestick reversal pattern. We're still looking for a trend in the market. We're still looking for a directional move, so to reverse a directional move. The only difference is ultimately the name of the candlestick reversal pattern. Now here, what you can see is you've got this down move here. Okay, it's not the strongest down move in the world, but it's a down move all the same. But what do we have? What's important? Previous level of resistance. Okay, so we know this is a level that the market's like. We've identified this as a level. The next time the market pull back to that level over here, we're going to be looking to sell the markets. And that's what we get the opportunity to do here. So we get the little sort of doji looking candle at the top there. You then get this massive bearish engulfing candle. Okay, that engulfs the entire candle over there. We place our stop above the high. We enter on a break of the low here, stop above the high, and you can see that the market roars off and pays you. It really is as simple as that. There's not too much more to this stuff. All you have to do is learn how to identify the levels, learn how to identify price action, and then be patient enough and disciplined enough to trade these at the right places. And as long as you do that, you'll be putting yourself in a good position to make money from trading the FX markets. Finally, let's take a look at the bullish engulfing pattern. Here you can see, again, we've got a nice up move here. The market is moving up constantly. It pulls back to what? Previous level of support, previous level of resistance. A little bit of resistance there, definitely support there. The market roars off from there, pulls back to it. What happens? We get a negative looking candle here, then we get a very, very bullish candle. This blue candle here completely encapsulates the body of the previous candle. We would then look to enter on a break of the high of this candle here with our stop below the low of the candle, and look at what happens. The market never even looks back. Beautiful, beautiful trade. Okay, so as I said, we'll show you some of these on charts. So we'll go to some live charts in a second and show you some of these in the live market. But hopefully this should give you a good idea of what we're looking for. So you can download these slides, look at them, study these slides very, very well. Then pull up some charts of your own. Take a look to see if you can identify those as well. And remember, you're not looking to identify those candles that happen in the middle of nowhere. You're looking to look at the candles that occur at predefined levels of support or resistance. Now, I know you're getting bored of me saying that, but it really, really is paramount to our success. It's very, very important. If you don't trade that, I'm not saying you can't be successful, but you will certainly have a lower strike rate. There's no doubt about that. So do yourself a favor, get disciplined, learn to be patient, to wait for the right opportunities in the market. If you can wait for the right opportunities in the market, then you can make money. If you don't want to wait for the right opportunities, if you don't want to be disciplined, then unfortunately you're going to suffer the consequences of that. Okay, so I hope you enjoyed this video here, and I look forward to speaking to you on the next video. Ciao now.